So today we're going to talk about Chapter 12, Revenue and Inventory Related Frauds and Financial Statement Frauds. So the learning objective is to learn about revenue-related frauds, learn to search for symptoms of revenue-related fraud, understand the importance and ways to follow up on revenue-related fraud. Then we're going to discuss inventory fraud and the same types of things, ways to search for inventory-related fraud, and then the importance of following up and other symptoms that we'll find. The most common account manipulated when perpetrating financial statement fraud is revenue. And that's true for a lot of reasons. First, revenue is the biggest account on the financial statements, and it has a direct effect on net income. So most of the time when companies are committing financial statement fraud, they're trying to increase net income. So in order to do so, you need to hide a material fraud in a big account. It would be difficult to hide fraud in prepaids, for example. And since revenue is the biggest account on the financial statement and it has a direct effect on net income, then it's a prime target for fraud. The other reason why it's a target for fraud is that, and you have to follow the logic on this, but when you commit financial statement fraud and the purpose is to increase net income, then you're trying to get credits onto the income statement, and then the debits have to go on the balance sheet. You can't have a fake credit and a fake income statement. A fake debit and a fake credit on the income statement because it would net out. So you put the fake credit on the income statement and then the fake debit on the balance sheet. So with the case of revenue fraud, you create fake revenue, you put the revenue, you credit revenue on the income statement, and then you have to put a fake debit on the balance sheet. Now you're not going to put a fake debit to cash on the balance sheet because that's the easiest thing to audit. But the thing that makes revenue particularly susceptible to fraud is that there's a convenient account to put the fake debit, which is accounts receivable. Because unlike cash, accounts receivable is hard to audit. The receivables represent IOUs from customers, potentially for large firms, hundreds of thousands of customers. And so finding out which particular customer IOUs are fraudulent can be difficult. And so the revenue is large, it has a direct effect on net income, and there's a place to hide the debit on the balance sheet. And according to research, over half of all financial statement frauds involve revenue and or accounts receivable. And I would say it's even higher than that. Most of the time, most of the frauds that I looked at in my research, I'd say about 75% of them are revenue frauds. And that doesn't mean they're not doing other things like lowering expenses. But they're also committing revenue fraud. The big notable exception to the revenue fraud is WorldCom. WorldCom actually committed fraud strictly on expenses. But again, revenue, the other thing that makes revenue fraud prevalent or common among financial statement frauds is that revenue recognition can be extremely difficult to determine when you should recognize revenue. And the standards related to revenue recognition are long and sometimes difficult to follow. And it seems like, well, why would that be? So why is revenue so hard? Why is it so hard to know when to recognize revenue? Well, if you think about a merchandise seller, like you go to Sears, if you go in and buy a shirt at Sears, Sears is going to recognize revenue the moment that you hand over your credit card and they charge it. So that seems pretty straightforward. You bought a shirt from them, you take possession of the shirt, they charge your credit card, and they get the money for it. But not all revenue is recorded like a merchandise would be. For example, there's software sales. So companies that sell software oftentimes sell that software in conjunction with hardware. And when they sell the software, the company has the right to use the software for maybe 5 years, and with that, they get upgrade rights. So you may have a situation where you sold a piece of hardware that has software connected to it with upgrade rights and maintenance on that software for the next 5 years. So that software purchase has the original license agreement connected with it, the maintenance contract, they have to maintain the software for 5 years, plus you get upgrades with that. So each part of each component of what we discussed, either it's the license fee, the upgrade right, or the maintenance, all could be recognized at different times throughout that 5-year period. And so recognizing revenue can be extremely difficult. And anytime there's complexity in the financial statements, and when estimates need to be made, then there's opportunity to commit fraud. And so revenue recognition can be complex. Revenue is a large account, has a corresponding debit on the balance sheet that's hard to audit, and has a direct effect on net income. So for all these reasons, revenue is a prime target when somebody wants to commit financial statement fraud. There's a lot of classic revenue frauds throughout the year. There's related party transactions. So that's when you sell product to a related party, and that related party may plan to return the product or not keep the product, and it was actually a sham sale. And an example of that is Lincoln Savings and Loan. So Charles Keating of Lincoln Savings and Loan, you probably read about in your book. He was CEO of the Savings and Loan, and he had a bunch of land that the Savings and Loan had reacquired due to people defaulting on their mortgages. And so his income statement didn't look good because he had a lot of defaults on the loans, and so he didn't have as much revenue as he would like. Plus, his balance sheet didn't look good because if you're a bank, you don't want to own real estate. That generally means that somebody defaulted on a loan, and then you have to collect the real estate as collateral. So that's bad news. So he had a bunch of real estate that he didn't want on his balance sheet, and he had low net income because he wasn't bringing as much revenue as he would have liked because people were defaulting on their loans. So he was determined to make his financial statements look better. So one way he thought that he could do that was to sell the land at inflated prices. But nobody's going to buy land at inflated prices, especially in a depressed real estate economy that was occurring during this time. And so what he decided to do was to find a related party, a friend of his, who would agree to buy the land from him at an inflated price. And he told his friend, well, the only reason that the real estate market is down is and this property is undervalued is just because of the economy. But the economy is going to pick up, and the land's going to become worth something. And so you buy it from me at a certain price. Just agree to buy it. You don't actually have to give me any money because I'm gonna do the mortgage on this purchase as well. So all you have to do is sign a mortgage to show that you purchased this land, and then purchase it at an inflated price. That way I can show the revenue of selling this land at an inflated price. That'll make my income statement look better. And I'll guarantee you that you'll get a hefty return when you resell this land in the future. And if you don't get a hefty return, then I'll make up the difference. So since the risk of loss on that sale of that land never transferred to his buddy, they should not have recorded the land sale as a sale on Lincoln Savings and Loan's books. So the reason that he was able to create this sham transaction was because he had a related party, he had a buddy who agreed to the purchase. So related party transactions are not illegal, and generally they're not a problem. But whenever you have a related party transaction, there's a potential for a non-arm's length transaction to occur, and fraud can potentially occur. Enron had a lot of related party transactions that were set up to perpetrate fraud. There's just the other example of revenue frauds is just sham sales. That's just where you just fake sales. There was a company named MicroStrategy that was just shipping bricks just to show that they shipped something and to record sales. So there's nothing particularly tricky about that. It's just a sham sale. There's bill and hold, and that's where you anticipate a big order from a customer, but that order hasn't come in, and it's the end of the year, and you want to record the sale. So you bill it and record the revenue right away in anticipation of getting that large purchase order from your customer. Then you bill it before year end, then you just load up the truck with the shipment and then just park the truck on the side of the road until the actual purchase order comes in. Then when the purchase order comes in, then you drive the truck down to and deliver the goods to the customer. So it's a timing problem. So you sell you bill and sell the product before you actually ship it. There's side agreements. That's where you may, and this happens in consignment sales, or in channel stuffing, which is the last one, but you may have a side agreement where the person can return the product free of charge And if somebody can return product without no questions asked, then you can't actually record the sale. And you may think, well, what about the Sears example where, if I buy a shirt from Sears, I can actually return it, within 30 days or 60 days, or whatever the return policy is. And that's okay because Sears sets up an allowance for returns. So retailers have a pretty good idea of how much returns come back at any given time. So they set up an allowance for that to happen. But if it's the end of the quarter or the end of the year, and you want to make a lot of sales, you can promise your customers, hey, just buy a bunch of product for us right now, maybe at artificially low prices so that we can record as much sales as we can prior to year end. And then if you don't sell it, then just send it back to us. So it could be that if you're Microsoft and you want to sell a bunch of your new operating system and it's December 31st or late in December, you could call up your resellers like Costco or Best Buy and say, hey, if you guys buy our new operating system, we'll let you buy it at half price right now, and you can return the ones you don't sell, within 60 days. And they, of course, would make a big order, and you would be able to meet certain sales targets. Maybe that was your goal all along, and record, the net income that you were expecting at year end. And that would be a case of channel stuffing. And then what would happen is those unsold items would come back, shortly or, a month after year end. And so you can't actually record those transactions as sales if they have a right of return. Now, they don't put the right of return on the invoice. What they'll do is they'll make a verbal agreement so that the auditors don't see that there's a right of return. Because if, again, the risk of loss or they have a right of return as a transfer, then they can't record the sale. So the other issue that comes up is consignment sales. So some folks put their inventory on consignment to resellers. They didn't actually sell it to the reseller. It's just there on a consignment until the reseller sells it, but they'll record the sale as if they had made the sale when they consign the goods to a reseller. So there's a lot of different ways to commit revenue fraud, and those ways have all been tested throughout the years. Some other ways to commit revenue fraud are lapping or kiting, because that's what happens to cover up the fraud scheme. So if you commit revenue fraud, you put the fake revenue on your income statement and the fake debit on the balance sheet. Well, those fake debits, those fake receivables are not going to be collected. The cash isn't going to come in. And so to keep your accounts receivable from not looking too old and those invoices getting too outdated and then having people raise questions, you can do lapping or kiting, and that's where if customer A pays and they're a legitimate customer, you record their account, then customer B pays, and you use customer B's money to then cover up a fake receivable, maybe from customer C. And then customer D's fake as well, and customer E pays, and use customer E's invoice to pay to cover up a receivable from customer C that was fake. And so you're constantly using checks from other customers to update your old receivables, so not the customer's actual account. And so you're always lagging behind a little bit in terms of updating your accounts receivable, but nothing gets too old. So that's one way to conceal a revenue fraud. There's redating and refreshing transactions. That's maybe you redate your accounts receivable to try and make it look like it's not as old. Getting back to returns, if you have liberal return policies, and they have a right of return, oftentimes a verbal agreement, and they have that verbal right of return that you've given them, you can't record the sale. So partial shipment schemes, that's where somebody may have ordered a product, ordered a lot of product from you, but they don't want it all at the same time. So they have a purchase order to send maybe 20 items in January and another 20 items in February. And what you'll do is you'll record all of the revenue in January, even though you're not going to deliver some of it until February. And that's the same as the next one, which is improper cutoff. So that's just when you record sales in January and in December. So December 31st comes, you still haven't met your sales and income targets. So you keep recording sales at January 1st, January 2nd as December 31st sales to try and get those sales in prior to year end. And that's just they're not fake sales. It's just that you have sales from the wrong period, from the next period in the current period. Round tripping is when then this happens periodically where customers or companies will talk to their customers and maybe a competitor that sells a similar product, and they'll say, hey, you buy 1 million items from us, and then we'll turn around and buy 1 million items from you. So the only reason to make the sale is just to increase revenue, because you're going to turn around and resell your product back to them. So you're just trading product but trying to record sales. So that's another scheme. So how does it work with revenue-related frauds? I mean, how's the revenue collection process normally work? Well, if you just walk through a flow chart here, and item 1, you sell the good. And then item 2, you have to estimate what your uncollectible receivables are going to be. And if the good's returned, then you put it in returns. If it's not returned, then eventually the customer is going to pay. So the receivables paid. If they pay within your discount period, so maybe you have a policy of 2, 10, net 30, where if they pay within 10 days, they get a 2% discount. Otherwise, they got to pay the full amount in 30 days. Well, if they pay within 10 days, then you can decide, okay, is that appropriate that they took the discount? And then you record the cash. Right? If they don't pay right over time, then eventually you have to write off the receivable. So the issue with revenue-related fraud is, like most white-collar crime, it's rarely observed. So we have to look for symptoms, red flags that might indicate fraud. We'll talk about each one of these: the analytical symptoms, the accounting and documentary symptoms, lifestyle and control symptoms, behavioral and verbal, and then tips and complaints. All these things are red flags that potentially indicate revenue fraud. We'll talk about each one. So in analytical symptoms, that's when revenue or sales that appear too high. And the question that becomes is too high compared to what? And it could be too high compared to prior years, too high compared to what their competitors are doing, right? And to do good analytical procedures, you have to develop your expectation of what you expect revenue to be. So if a particular company that you're auditing or that you're potentially going to invest in, and you look at their revenue and you think, well, this company is doing really well. They've done well in the past. I know they opened up a few more stores this year, and the economy is going well, so I would anticipate that revenue is going to be up from the previous year. So you develop your expectation that maybe revenue went up 5%. Then you look at their actual revenue, and if it's up 5%, then that's consistent with your expectation, and there's not an anomaly there. But maybe it's a situation where it's Target stores, and you think, well, you know what, they got rid of their Canadian operations. They decided that they weren't going to be successful in Canada, and they closed a bunch of stores there, and the economy's not doing so well. And so I would anticipate that from the previous year, the fact that they have fewer stores, the economy's not doing well, that the revenue would be down. And then when you look at the revenue and the revenue's up, then you think, well, that's a little bit suspicious. So what's causing revenue to be higher than what I had expected? Right? So when you see revenue or sales growth that appears to be too high relative to your expectations about what you know about the company, what you know about their history, what you know about the competition, what you know about the economy. When that appears to be too high, then obviously you would discuss that situation with management. And if they can't give you adequate explanations, then you have to consider fraud as the explanation. So others is when sales discounts that appear to be too low. So customers aren't taking discounts for some reason, that might raise red flags. And discounts, again, too low to what? Well, probably too low to prior history. Then sales returns that appear too low. So it doesn't appear that customers are returning their product very often, so their returns and allowances is too low. That might be a red flag that they're artificially trying to increase revenue. Bad debt expense appears to be too low. So they have a lot of, their accounts receivable keeps growing. And again, this is a fraud firm, so their accounts receivable keeps getting bigger and bigger and bigger, but they're not taking more bad debt. So that might lead to you to be suspicious. Right, accounts receivable that appear too high are increasing too fast. So if you created a revenue fraud, and you created fake revenue, and the amount of fake revenue that you recorded is 10% of your overall revenue balance, well, that means your revenue went up 10%, but that 10% of revenue that's in accounts receivable is going to be a much higher percentage of accounts receivable than it is going to be for revenue, because the amount, that 10% of your sales that's in accounts receivable, as a percentage of the uncollected sales, it's going to be a much higher percentage. So you can oftentimes find a revenue fraud by unusually high increases in accounts receivable. So you may have revenue that, for example, that went up 10%, but accounts receivable is up 50%, and the revenue it doesn't match. So you would expect a corresponding increase in accounts receivable as sales, but if accounts receivable is going up much higher relative to sales, then you might be concerned. And similar to bad debt expense that appears to be too low, that's because you may think that the allowance for doubtful accounts appears to be too low. So maybe in the prior year, they had 10% of their accounts receivable was in the allowance. Maybe this year it's 5%, and you think, well, that's just a little bit too low based on historical write-offs that might make you concerned and suspect that they're committing fraud in the revenue cycle. And then also related to that is too little cash is collected relative to reported revenues. So they're recording a lot of revenue, but the customers aren't paying. That's going to manifest itself in higher accounts receivable as well. So all those things could be analytical symptoms that you would look at to look for revenue fraud. And it's a little bit like squeezing a balloon, right? When you commit fraud, it's like squeezing a balloon, and the balloon's going to pop out somewhere. That fraud's going to pop out somewhere in the financial statements in some unusual fluctuations or anomalies. And oftentimes, like we said, if there's fake revenue, it's going to pop out as unusually high accounts receivable. So accounting and documentary symptoms. So first, you could have unreported or unauthorized revenue-related balances or transactions. And so obviously when things are unauthorized, then there's going to be a concern. So if you see sales that weren't authorized or sales that are outside the normal course of business, so maybe somebody's recording sales, making manual journal entries right near year end, in the middle of the night to record sales, that might make you a little bit suspicious. Because normally when you record a sale, it happens when you produce the invoice. So it happens automatically when the sales department generates an invoice. You don't have to make a manual journal entry. So if you see unauthorized or manual journal entries to record revenue, that might make you suspicious. Right? Missing documents in the revenue cycle. Like we talked about with the bill and hold sale. Maybe you're testing revenue as the auditor and you look at it, you say, well, what about this particular sales transaction? I want to get the revenue and the shipping document related to this, otherwise known as the voucher package. So you'd want to see a purchase order, a shipping document, and then an invoice. Well, you get the voucher package, and all there is an invoice and a shipping document with no corresponding purchase order. That might make you concerned that the company that they shipped the product to didn't actually order it. And part of when you recognize revenue, one of the things that has to be in place is that there has to be persuasive evidence that an arrangement for a sale exists. And if there's no purchase order, then there could be evidence that is not a legitimate sale. So you can ship product, and one way that you can create fake sales is actually shipped product to customers that didn't order it. It's going to come back, but you don't care because all you want to do is record the sale right at year end and potentially get it past your auditors, and you'll worry about the return later on. So missing documents like missing purchase orders could be a problem. Also, if there's photocopies when originals should exist. So you see a real invoice and a real shipping document, but then a photocopy of a purchase order. And anytime there's photocopies and not originals, that's going to make you suspicious because there's original purchase orders somewhere, and that should be attached to the voucher package. And if it's missing a purchase order, or if the purchase order is a photocopy, then maybe they created fake purchase orders just for documentary purpose to create an audit trail. So anytime you see photocopies when originals should exist, it makes you suspicious. So, and then the other thing is sufficient unexplained items are bank and other reconciliations. So if they have bank reconciliation, and this isn't true, this isn't just true of revenue frauds, this isn't true of a lot of frauds. If they have a lot of reconciliations and there's a lot of unexplained items, well, obviously the unexplained items is the fraud. So you have to ask about those, and if you can't get legitimate explanations for these unexplained items and then the reconciliations, then you have to consider fraud as the likelihood. So revenue-related ledgers that don't balance. So you have a sales ledger that doesn't tie to the GL. So it may be that they recorded all their sales in the sales journal, but then they made some manual journal entries outside the revenue invoicing process. They created additional sales, and now the sales ledger doesn't actually match the general ledger when it comes to revenue. And so when you see situations like that, you also have to consider that maybe fraud's a possibility. Control symptoms. One control symptom that could be problematic is management overrides significant internal control activities related to the revenue cycle. And management override is a problem for most accounting systems, because internal controls are only as good as are only good if people are actually following the controls. But if management can override those controls at any given time, which they generally can, then management always has the opportunity to commit fraud. And management usually does have the opportunity to commit financial statement fraud, because they're the ones who prepare the financial statements, and they're the ones who oversee internal controls, and there's almost always a mechanism for them to override those internal controls. So another control symptom is new, unusual, or large customers that appear to not have gone through the customer approval process. So the customer approval process, the way that plays out is when a new customer makes an order from you, you don't just ship them product and then expect them to pay within 30 days when you send the invoice over to them. Because essentially, when you ship before you receive payment, then you're extending credit to a customer. We don't want to extend credit to people who are not creditworthy. So when you get a purchase order from a new customer, then the thing to do is to send it over to the credit approval department, and they'll look at the customer. They might look them up on Dun & Bradstreet to find out what they can about them, might determine if they're a legitimate customer and what their creditworthiness is, and maybe do a profile or credit check on them. And if they feel like this is a legitimate customer that they can extend credit to, then they'll put them on an approved customer list, so that they don't have, every time a customer doesn't or makes sends over a purchase order, you don't look them up if they're already on the approved customer list. So you keep an approved customer list, but if you're noticing large customers making transactions right near year end, and these customers don't appear on the approved customer list, doesn't appear to have gone through the approval process to extend credit, that might make you a little bit suspicious that these are fake customers just to record fake sales right at year end. And then weaknesses in the cutoff process or other key accounting processes. Right? So if there appears to be weaknesses in the cutoff process at year end, because right at year end, at December 31st, they need to stop shipment, and all of the shipments that happen where they do their inventory counts, they stop shipments, they do their inventory counts. Then anything that's shipped in January is going to have a shipping date in January, and the inventory that's being shipped should be properly included at ending inventory at prior year end, and the sales should be properly excluded from the sales journal at the prior year end. So if you're looking at that and you see problems where there's shipping documents dated one date and then invoicing date and a prior date, then that would obviously be a red flag. So the behavioral and verbal symptoms are pretty much the same for no matter what type of fraud we're talking about. Anytime management gives you inconsistent, vague, or implausible responses to do your inquiries about any of these symptoms, then that's going to be a red flag. So if you come to the company and say, hey, I know that you have fewer stores than you had the prior year, right? You're selling fewer products. I would expect revenue to go down, but you show revenues up. So you have the number of stores have decreased 10%, but revenue's up 30%. So what's causing that difference? And if they can make an explanation that, yeah, we have fewer stores, but the stores that we closed were stores that weren't performing very well anyway, and the economy's good and we're able to raise prices on a number of our products, and they can give you an adequate explanation, then you think, okay, well, that's, maybe there is an explanation for why sales are up, even though They have fewer locations to make sales, fewer stores. But if you talk to them and they give you some vague explanation about, well, yeah, we got rid of some stores, but we increased our online sales, and we increased our prices by 40%, and you don't ever remember there being a price increase, and their online sales are immaterial to their total sales, and you go back and investigate that, and it just doesn't seem to jive with what they're saying, then obviously that would be a concern that they're actually committing fraud, and they're just giving you some implausible explanations to make you go away. Anytime they deny access to facilities, employees, records, customers, vendors, that's going to be a concern, right? So you ask questions and they say, don't talk to that employee, or don't talk to this employee, or we can't let you go into these facilities and look at the sales journal. Then that's going to be a red flag. But again, this is going to be red flags no matter if it's revenue fraud or inventory fraud or expense frauds. Anytime they give you implausible answers and don't give you access to the records or their employees, you're going to be suspicious. And also if they put undue time pressure. So you have extremely complex revenue recognition issues right at your end. You're trying to determine, they have some major sales, you're trying to determine the appropriate revenue recognition treatment, and they're putting pressure on you to wrap that up so they can recognize revenue as soon as they can. And anytime they put pressure on you related to complex issues that require some thought is going to be a red flag. And again, these behavioral and verbal symptoms are going to be the same no matter what fraud we're talking about. So over the next several chapters, we're going to see the same behavioral and verbal symptoms that management displays that are going to cause you to be suspicious. Now, lifestyle symptoms are not generally a good way to detect financial statement fraud, because management generally has a pretty good lifestyle already, because if you don't get to be the CEO and CFO without having some money, eventually, I mean, you've accrued a pretty high salary as you worked up the ladder, and so you don't see a significant change in their lifestyle once they start committing fraud. Like in the case of embezzlement, when employees are embezzling money, you're likely to see lifestyle changes, because oftentimes they're lower level employees who are not making high salary, but once they start stealing, then they start driving new cars, they show up with new clothes, they may become irritable, their behavior changes because they're under stress because they're committing fraud. You don't generally see as much of that as lifestyle changes for fraudulent financial reporting, because management's already rich, so you don't actually see them make a change in their lifestyle. However, if they are making major sales of company stock around earnings releases or on other dates, like around acquisitions and other things, that might be a sign of insider trading, and also a sign that they're doing something suspicious related to the financial statements. In this case, we're talking about revenue. But if they have significant revenue, like right in the last couple weeks of the year, maybe they bring in like 40% of the revenue for the year in like the last 2 weeks, and they're also selling their stock at the same time, you think, well, maybe they know that these sales are not legitimate, and they're trying to get rid of their stock right now. Well, the stock price is high because they met their earnings targets, because they know next year that the stock price is going to be lower when they don't meet their earnings targets. So these are all things that may cause you to be suspicious. And there's not going to be any one thing that leads you to believe, oh, they're committing fraud. So if you see a significant increase in accounts receivable, that by itself might not lead you to believe that they're committing revenue fraud. But if you see a significant increase in accounts receivable, you see companies reporting maybe 4% of the revenue, like in the last 2 weeks of the quarter or the year. You see management making significant stock sales around what supposedly is a good quarter, right? Once the red flags keep adding up and there's just more and more of them, they can't give you adequate explanations for why their sales increased so much, in the last 2 weeks. The more and more the red flags build up, the higher and higher likelihood that there's fraud. That's why we talked about earlier in the last chapter that there's a lot of false positives related to red flags. And that's true. There's not going to be any one red flag. Most companies have a red flag here or there, but they're easily explained once you look into it. But if there's multiple red flags and they just keep piling up, that's where you start to suspect fraud. And then tips and complaints are the same. They're going to be the same across all types of frauds, including revenue fraud. So if somebody blows the whistle that there's improper cutoff, at year end, or there's creating sham sales that gets tipped off as a whistleblower, of course you're going to investigate that. But that would be the same in an inventory fraud or an expense fraud, any type of fraud. When if people provide tips or complaints and you find out about these things, obviously you're going to investigate. So that's revenue fraud. Again, that's the biggest fraud that occurs across financial statement fraud. And like I said, maybe 75% of the frauds that I've investigated have revenue-related frauds. Right below that, in terms of the number of frauds, is inventory fraud. And you may ask yourself, well, why do people commit inventory fraud if their purpose is to increase their net income? Well, one way to increase your net income is to decrease your cost of goods sold. So in this slide here, we see that gross revenues minus returns and allowance gives you net revenue. Then you subtract out your cost of goods sold, that gives you your gross margin. And then obviously your selling, general, administrative expenses, you subtract that out, gets you to net income. Well, if you can materially reduce your cost of goods sold, then you can materially increase your net income. So how can you increase your cost of goods sold? Well, the one way that you can increase your cost of goods or decrease your cost of goods sold is by increasing your ending inventory. Because at the end of the quarter, at the end of the year, when you're calculating cost of goods sold, you're going to add purchases, less returns, less purchase discounts, going to give you goods available for sale. Then subtract out your ending inventory, and so you take your goods that were available for sale, subtract out the inventory that you still have, which is your ending inventory. It's going to give you your cost of goods sold. So if you can artificially increase your ending inventory, you'll artificially decrease your cost of goods sold. And by decreasing your cost of goods sold, you can artificially increase net income. Right? So again, the purpose when you commit financial statement fraud generally is to reduce the debits or increase the credits on the income statement. So in this case, you're artificially decreasing the debits and cost of goods sold. And so you keep those debits low. So where do those debits show up? Well, they have to show up on the balance sheet, and they show up on the balance sheet in inventory. So you have fake debits in inventory so that you can artificially keep cost of goods sold low on your income statement. So how can you artificially overstate your ending inventory? Well, I mean, there's simple things. You can double count inventory. You can capitalize expenses into inventory. You can have cutoff problems where you record sales, but then don't take the inventory out of your inventory. So you have cutoff problems. So you record a sale right at your end, but still leave the inventory and count it as inventory at your end. You can overestimate your inventory. Right? And we talk about inventory like you're just counting boxes. I mean, you could be an oil refinery where you have vats and vats and vats of oil and barrels and barrels and barrels of oil. So as you're looking at these vats, right, you can overestimate how much inventory is in those vats. One of the clients that I audited was a rock quarry. And so when we counted their inventory, we were just looking at piles and piles and piles of rock, granite rock. And the way that we would estimate how much inventory they had was we looked at aerial photos of those piles of rock and sort of geometrically determined how much inventory was there. Well, you can see we're not counting individual rocks, and that estimating of inventory could be a little bit subjective, and what you can overestimate inventory that way. We talked about the bill and hold sales. Same thing, where you can ship the inventory as a sale and record it as a sale, but still hold it in your warehouse. You record a shipping document, but you don't actually ship it, and then you hold it in the warehouse and double count it as inventory at year end. And then consigned inventory, inventory that's consigned to you, that's from maybe from one of your customers. They've consigned it to you, but you count it as your inventory. So there's a lot of ways to overstate what your inventory is. And there's a lot of famous inventory frauds that are out there. So how would it normally work when the inventory and inventory purchase and production cycle. So the first, you produce your inventory. If it's good inventory, then you hold it. If you've inspected it and it's bad, then you return it. Right? If you pay on time, then you take your discount. If you don't pay, within their discount period, then you pay the full amount. Then you sell your inventory, you ship it. If you don't sell it, but it becomes bad or becomes obsolete, you may have to take a write-down for inventory obsolescence. And again, inventory, one of the reasons inventory is a good location to put financial statement fraud, because there's a lot of estimates that go into inventory. Like we mentioned, there could be estimates into just estimating how much inventory you have. There's also a lot of estimates into determining whether your inventory is obsolete. Because one of the things that you have to do at your end is determine whether you have to record your inventory at the lower of cost or market. And so you have to estimate what the market value is, right? And if you think the market value is less than what you paid for, then you have to write your inventory down. So a lot of estimates go into it. It's inventory accounting is complex. Anytime you create complexity, you create an opportunity to commit fraud. So if you sell your inventory, you ship it. If the inventory sits on the shelves for a long period of time, it may become obsolete, so you do your lower of cost or market calculation. You write it down if the market value is actually lower than what you paid for it. Then you determine if it can be counted in inventory at year end. Year end comes, you count your inventory, and then you calculate your cost of goods sold. So what are the analytical symptoms? Well, reported inventory balances that appear too high are increasing too fast. And again, the question always becomes, too high compared to what? And it's compared to what you would expect. And so if their sales have grown significantly over the past year, you would expect a corresponding increase in inventory. Right? But if inventory is growing faster than what you would expect, so sales are growing 5% a year, but their inventory is growing 20% a year, that might make you a little bit suspicious. Right? Or their inventory is growing faster than their competitors. So you develop an expectation of what you think the inventory balance should be based on historical factors, based on the economy, based on what you know about their competitors. You come up with an estimate, and if their inventory balance is higher than what you would expect, then you consider, well, maybe they're overstating their ending inventory. Right? Another analytical symptom is reported cost of goods sold balances that appear to be too low are decreasing too fast. So their gross margins just keep getting better. So when they take their revenue, their net revenue minus their cost of goods sold, that percentage just keeps getting bigger and bigger. So anytime their gross margin keeps getting better and better and better, then you have to ask yourself, what are they doing? Why are they able to produce inventory at cheaper and cheaper amounts? And maybe that they're not able to do it. They're not becoming more efficient. They're just overstating their ending inventory and understating their cost of goods sold. So you want to consider that. Reported purchase returns that appear to be too high are increasing rapidly, and purchase discounts that appear to be too high are also increasing too rapidly. Those are also concern. Inventory purchases that appear to be too low for the sales or inventory levels. So all these things could artificially increase our ending inventory and decrease our cost of goods sold. Our capitalized inventory looks like it should be expensed. So you're looking at items that they capitalized into inventory, and you're like, you know what, those actually look like just regular expenses, and they're not actually increasing the value of your inventory. So maybe somebody's cleaning the warehouse, and the salary that they pay to the janitor is cleaning the warehouse, they capitalize into the value of the inventory, and you look back on that and say that doesn't look legitimate, right? It looks like you're finding ways to overstate your ending inventory. So accounting and documentary symptoms. Inventory or cost of goods sold transactions that are not recorded in a complete or timely manner are improperly recorded as to amount, accounting period, classification, or entity. So again, these are things where inventory and cost of goods sold transactions, when you go back and look at them, you're not quite sure the accounting related to that inventory and how that inventory should have been transferred to cost of goods sold. There may be their capitalization items related to that inventory, because the people who work on the floor in production, their wages should go into the cost of the inventory, because that's part of the wages, part of the cost of producing the inventory. But if you see that there's incomplete records about how that inventory or how wages for production personnel are being allocated to inventory, and you're not quite clear, it looks like they may be taking people who work in sales or in headquarters and putting their wages into the cost of the inventory, and you can't tell because it's not properly, there's not enough documentation to determine where these employees are working and if they're actually working in production. So all of this could lead you to believe that maybe there's something suspicious going on. So anytime there's incomplete records, especially related to inventory, because the recording of inventory is complex, and you don't get a clear picture of their capitalization process and how they actually record inventory, you're going to be suspicious. If they have unsupported or unauthorized inventory or cost of goods sold related transactions. So there's a lot of they have purchases that weren't authorized to be purchased. Right? They don't have good controls over purchasing and selling and when things should be recorded. You're going to be suspicious. If there's, again, end of period inventory or cost of goods sold adjustments that change the financial results. So they record their cost of goods sold, and then the subsequent management comes in, overrides internal controls, makes another entry where they take cost of goods sold, where they credit cost of goods sold and debit inventory to show that there's more ending inventory and less cost of goods sold, and now they've magically met earning targets. And you see these manual journal entries that look suspicious that are made right at quarter end. That might lead you to believe that fraud's occurring. Missing documents related to inventory and cost of goods sold. So the same thing as like missing documents that we talked about before. So if they're granite rock and they have piles of granite and the aerial photos are missing and you can't actually estimate how much inventory is there, then you're going to be suspicious. So anytime there's missing documentation or photocopies, again, you're going to be suspicious. So control symptoms, again, if management can override internal controls, there's potential for problems. Now, management can almost always override internal controls, but if they're doing it on a regular basis and creating manual journal entries close to your end, management's doing it, and these debits to inventory, there's suspicious credits to cost of goods sold made by management, then you're going to be suspicious. Similar to revenue fraud and unusual customers, if there's unusual vendors that appear to not have gone through the regular vendor approval process, you could be concerned. Or if there's vendors who they haven't been making purchases from, that might make you a little bit suspicious if there's regular vendors and they're not making purchases from those vendors. And then if there's weaknesses in the internal at the inventory accounting process, and I would see that when I was an auditor, I'd go out and count inventory with the client, and if their counting procedures were not accurate and my test counts were always different than theirs, then I'd have to go back and say, it doesn't look like you're prepared to do these counts because we always come up with different numbers, so I can't rely on the number that you come up with. So I'm going to have you recount it all, right? And then come back and count it again to make sure there's no discrepancies. So when you find weaknesses in the inventory accounting process, you're going to be suspicious. But there's a lot of things that could make you suspicious even when you're out doing the inventory counts. Because if you see piles of inventory that look like scrap, and you ask, what is that? Is that? And they say, oh, we've got rid of that. Well, is that in your inventory balances? Oh yeah, that's still there. Well, why is stuff that's been scrapped still in our inventory balances? Right? If you walk around and you see like empty boxes that appear to be stacked together, or you see boxes that look like they're stacked, several boxes deep, but when you look behind them, they're not there. So if you see a bunch of sort of things that look suspicious, like maybe there's some problems with their inventory accounting process, and they may be double counting or counting things that aren't there, then you're going to be suspicious. And we talked about before these behavioral and verbal symptoms that continue to appear. They can't give reasonable or plausible responses to your questions about these analytical anomalies that you're finding, like this decreasing cost of goods sold, increasing inventory balances that don't look appropriate. You ask them how is it that their inventory is going up and their cost of goods sold is going down, even though they're generating more sales, and they can't give you a legitimate explanation, then you have to consider fraud. Right, same thing if you're trying to do your inventory obsolescence calculation and trying to figure out the lower of cost or market, and they're trying to hurry you and pressure you to make those calculations, and want those calculations to be consistent with theirs, and not giving you enough information or time to make those calculations, you're going to be suspicious. Unusual delays by the entity in providing requested inventory or cost of goods sold related information, and that could easily happen when you do your inventory count. So you go out and count inventory and you say, hey, I want to count these items on the list. They say, well, those items are in a warehouse and another location. Let's pick something else. And you say, oh, okay. You shouldn't pick something else, because if you're doing the inventory count with them and you pick an item, you shouldn't let them tell you that they can't count it. You have to go count it. But let's say you're doing a bad job and you say, okay, I'll pick something else. No, that inventory is not in a good place either. Let's count something that's close by. And they tell you what inventory to count. Then you got to be suspicious, right? If they're not finding the inventory for you that you want to count, then you'd be suspicious that maybe they're overstating their inventory. And the reason why this comes up, and this inventory fraud, and we talk about it as being one of the accounts that's easily manipulated, and it's because it has been manipulated quite a bit in the past. There's some famous inventory frauds, in your book talks about a couple of them. One's Farmore, and Farmore was a company that was similar to Walmart. They had a bunch of stores. They sold a bunch of miscellaneous goods, and Walmart was actually concerned. Sam Walmart said that one of the biggest competitors, my biggest fear for competition is coming from Farmore, which is, he said that several years ago when Farmore was big on the scene, and Farmore was committing ending inventory fraud. In fact, I had a friend one time who was in a Farmore store, and there's no inventory on the shelves, and they said, what's going on? And they said, oh, well, we're doing inventory counts, and so inventory's in another location. Well, what they were doing was their auditors were telling them where they're going to do their counts, and they were trying to overstate their ending inventory. So all of their inventory was in the stores that the auditors were counting, and the stores where there was an inventory, when the auditors weren't counting, there was no inventory. Right? And so one of the things that we talked about earlier is if you have to be strategic in your audit, and especially in a fraud audit, you have to think strategically and think, well, if they think that I'm testing inventory, I'm going to do counts, I've got to be unpredictable. So I'm not going to tell them where I'm going to do my counts. So you just tell the client, hey, you've got 25 stores. I'm not going to count them all, but I'm also not going to tell you which stores I'm going to count. So on the days of the count, all your employees at those locations should all be counting their inventory, and I'll show up at 5 of those stores. So you want to be unpredictable so that they can't move their inventory in the case of inventory counts and be sneaky, and then you don't catch it. There's another famous fraud called Crazy Eddie, and the Antar family had a small electronics company that grew very fast in New York. So they were selling inventory below what it cost them to purchase it. Of course, when you're doing that, and Crazy Eddie's motto was that our inventory is so low it's insane. Well, the way that what they were doing was they were committing ending inventory fraud. So they're understating their cost of goods sold, even though the inventory actually cost them more than what they were selling it for. They were understating their cost of goods sold. Looked like they were reporting a net income, and they were fooling their auditors by overstating their ending inventory. And they were trying to estimate what their auditors would do. And I've listened to their former CFO, who was a member of the family, Sam Antar, and he would say, yeah, we would distract the auditors all the time. They were doing their counts, and these were oftentimes kids that were right out of school, which is pretty common for auditing profession. Is you have your most junior people do the inventory counts, because they're usually done, on a weekend or on a holiday and you have to do inventory counts when there's no shipping or receiving. And so he said, as a young man, we'd bring girls by, we would distract them, we would go in the middle of the night after they did their count and change the numbers. Right? We would ask them to count inventory that we wanted them to count. We'd sort of make it easy for to count inventory that was legitimate and make it hard for them to count inventory that wasn't legitimate. So they had all kinds of techniques to fool the auditors, and they committed a massive ending inventory fraud. And the purpose was to not steal from the company itself, but to steal from investors, like most financial statement frauds are. And they got away with it for a long period of time, but then eventually like most frauds, especially a fraud of this size, they ran out of cash. And I mean, if you're buying inventory and selling it for less than what you're buying it for, eventually you run out of cash. And investors obviously were getting suspicious. And then Eddie Antar just skipped town and went to Israel and tried to hide out there. And the FBI was tracking him, and they knew that he had propensity to follow attractive women. So they put an attractive FBI agent out in front of his apartment where they thought maybe he was staying. And when he came down, and they put her out there with a car that looked like it was broken down, and Eddie stopped to help her, and then she identified him and asked him if he's Eddie Antar, and he was, and then he was caught, and they brought him back to America, and he went to jail. But I've heard his cousin, Sam Antar, speak, who was the CFO, and he's an interesting character too. He's the one that I listened to describe the fraud, how they did it, how they were able to create fake inventory and fool the auditors. And unlike Walt Pavlo, and I listened to Walt and Eddie and Sam Antar speak at the same time, where Walt sounded very contrite. Sam Antar was saying, "I'd do it again. I'm a fraudster, and I'm a fraudster at the heart. And if I could commit financial statement fraud, I would do it again." Right? So some fraudsters are penitent, like Walt. Some of them aren't, like Sam Antar. But there's just a lot of different ways that people can commit financial statement fraud, and ending inventory is a big one. Right? So going back to these lifestyle changes, these are things that we don't, like I said, you don't often see among executives. You don't see that their lifestyle is changing because they're already rich. But there could be some suspicious things if they are selling inventory, or not selling inventory, but selling stock at suspicious times. If their bonuses are tied to net income levels, then it's going to be suspicious, right? Obviously, there's tips and complaints. People are complaining that maybe their ending inventory is overstated, or that they're understating their cost of goods sold. If you get a tip, you're going to investigate, right? That's common among all types of fraud. So, and then inventory and cost of goods sold fraud, analyzing financial statements. Again, you're going to look for relationships within financial statements. So, is cost of goods sold going up, and it's not consistent with the increase in inventory. Right? Or is the gross margin, maybe cost of goods sold is going up, but not at the same pace as sales, and so the gross margin percentage is going down. That might make you suspicious. So there's a lot of different unusual relationships that you're going to look for. You're going to look for relationships with their competitors, relationships across time, relationships within accounts, and you may even look for relationships in non-financial information. So like we talked about, if maybe you know the size of their warehouse, like we talked about before, and if the inventory would not fit in the warehouse, that's another analytical anomaly that would make you suspicious, right? So there's a lot of things that you can do to detect inventory and revenue fraud, and we'll continue to talk about those throughout the course of this semester. So you stop and think, what are some potentially legitimate reasons for a company to have high inventory balances? Well, think about those and then stop and think, okay, does the company that I'm auditing or that I suspect fraud have any of those reasons? And if management can't give you legitimate explanations, and they give you vague explanations or implausible explanations like we talked about, then you have a right to be suspicious.